Thank you very much for waiting. Now we'd like to start the panel discussion number 3, Venture Capital Fundamentals and Path to Venture. The moderator is from University of California, Berkeley, Haas School of Business lecturer, Business and Public Policy, Professor John Metzler. The panelists are SemperVirens Venture Capital General Partner Ms. Allison Baum Gates, from Globis Capital Partners, Managing Partner Mr. Shinichi Takamiya.
Excellent. All right, I have the pleasure of moderating today, so I get to be the gaku in Sangakkan Renke today. If you're wondering if what it is Berkeley faculty is doing here in the fall, it is indeed the middle fall session. I taught classes this morning by Zoom before coming here today. So through the miracle of disruptive technology, such as that which we heard about this morning, I'm able to be here and still do my job. I am delighted to introduce our two speakers. I wanted to take a moment beforehand to reflect a little bit on what we've covered, because we've covered a lot of nuanced topics today, from private and public equities to enterprise technology to certain US-Japan deltas. And so there's been a lot of nuanced content and then a lot of rules of thumb that have been almost sort of casually shared by the various speakers. So hopefully those have had a chance to sit in. In this panel, we're going to try and scaffold and maybe reference some of the things that have been shared and build on them. So hopefully the scaffolding starts to set in over time. And with that, I am joined by Allison Baum Gates. I'm going to introduce an order of distance traveled to be here. So I'll start with Allison Baum Gates with SemperVirens Venture Capital. And then Shinichi Takamiya with Globis Capital, who did not have to fly here to be here today, the shorter commute. And we're going to start off with remarks from Allison, talking about her firm, SemperVirens, and sort of their value add and the nature of the firm. So with that, I would love to turn to Allison.
Thank you. Hello, everyone, and good afternoon. Thank you so much for having me. I'm Allison Baum Gates. I'm a general partner at SemperVirens Venture Capital. SemperVirens is an early-stage venture fund investing in B2B healthcare technology, workforce technology, and financial technology. We have about $250 million in assets under management across 4 funds, and we primarily invest at the early stage. But what makes our fund unique is what we call an ecosystem approach to venture capital, which I'll explain in a minute. Our fundamental thesis is that we're in the midst of a 4th industrial revolution, where our economy has become digital, distributed, data-driven, and dynamic. The systems and infrastructure that have been created to support the way that we work and create value in society need to be updated for a digital world. Typically, an employer spends about 70% of their budget on their workforce. And historically, they've had 0 information about how that budget is performing, how productive their employees are, what type of technology they're using, and what's going well, what's not going well, where they should be investing or not investing. In a digital economy, that's possible for the first time. And typically, in the US, individuals get their jobs from their employers, they get their health care from their employers, and they make their money from the employers. So we see this B2B channel as a very powerful way of influencing how technology is impacting everyone across the world. Even though our firm was founded 5 years ago in 2018, our entire team has been investing and operating in healthcare, workforce, insurance, and financial technology for more than 20 years. This means we've been building our relationships, our experience, and our theses for a very long time. We have an incredible platform team, which is the same size as our investment team. And this platform team focuses on providing value to all members of our ecosystem. This ecosystem is incredibly special because it is comprised of end buyers for our portfolio companies. So we started the ecosystem with 150 senior HR leaders at some of the most influential and global businesses in the United States. like Visa, IBM, Wells Fargo, UPS. And over time, we've grown that ecosystem to include other end buyers, such as insurance carriers, health plans, hospital systems, brokers, consultants, and other venture funds. Many of these companies are also LPs in our fund, and we work very closely with them to understand what are their priorities, what are their biggest challenges that technology can solve, where are they looking to invest time and capital, and then we can use that information to inform our thesis and make connections not only to our portfolio companies, but to other companies that we interact with that might create value for these partners. And while this is a really exciting ecosystem because it creates powerful relationships and collaborations, ultimately, we're financial investors. And we find that the ecosystem plays a significant role in our ability to provide strong financial returns to our investors. We'll talk a little bit about the fundamental of venture capital today, but what I found is that although it seems complex, it's actually very simple, and you really only need to do 3 things well. One is accessing the best companies and gaining the ability to invest in them. Our ecosystem helps us do that. We typically evaluate more than 1,500 companies across our target sectors, ultimately investing only in 10 per year. The second thing you have to do is analyze those opportunities and identify which ones to pursue. Our ecosystem also helps us do that. On average, we're able to collect at least 19 back-channel references with end customers before we make a decision to conduct actual due diligence on a company. This is powerful information about end customer demand and what companies are likely to gain and accelerate momentum in the near term and in the long term. And then third, you have to amplify the companies that you've invested in, adding value and providing an additional unfair advantage as they face the incredible world and challenge of building multi-billion-dollar businesses. Our ecosystem helps us do that by facilitating end customer introductions. To date, for our 50 portfolio companies, we've introduced them to more than 2,000 customers, resulting in commercial contracts as large as $15 million. This creates a positive flywheel that helps us ultimately continue to access great investments because we've added value in the past. We've built an incredible portfolio of 50 portfolio companies across next-generation benefits in mental health and fertility, and workforce solutions like apprenticeships, technology training, and remote and distributed team infrastructure, and in financial technology like retirement savings and financial wellness. My background is slightly different than a lot of the other speakers you've been hearing from today, so I wanted to share a little bit about my path to venture capital. After working at Goldman Sachs and a venture-backed startup, I got into venture capital by actually starting my own firm a little over 10 years ago. At that firm, we were a global seed fund investing in education and the future of work, and I had the privilege of working with investors and portfolio companies all around the world, from places like the US, of course, but also London, Estonia, Singapore, and even here in Japan. We specialized in helping companies expand internationally, and so we worked with several LPs and amazing portfolio companies and partners here in Japan. After making more than 70 investments and helping at least half of them expand internationally in some way, I moved to the Bay Area and spent some time in Silicon Valley at a more traditional venture capital fund, where I saw how quickly the industry was changing. And as an entrepreneur at heart, I had to take the opportunity to join my partners to build SemperVirens, where we're investing in important sectors, but we also believe we're enabling a new type of venture capital with our ecosystem approach. Through this process, I've built a strong personal thesis that venture capital needs more outsiders. We need people taking new pathways into the industry if we want more diverse voices around the table in order to fulfill the promise that technology actually has, which is to make the world better for everyone. As a result, I do a lot of teaching and writing about venture capital and how it works. And I even wrote an entire book demystifying the industry and laying out exactly how it works in my experience. I interview several other general partners at venture capital funds, and we all share our personal stories about how we learned these difficult lessons about how venture capital actually works, how to best access the best investments, how to analyze which ones to pursue, and ultimately how to add value to ensure long-term success. So I hope it's helpful for you, and I look forward to the conversation today. Thank you.
Before we hear from Shin, I just want to comment, I've seen the presentation a few times before this, but hearing it live is a very different experience, so thank you for that.
Yeah, thank you.
A lot of the messages really resonated. All right, with that, I would love to hear from Shin and a little bit about Globis.
Good afternoon, everybody. I'm Shin Takamiya from Globis Capital Partners. I think the exciting part of this session is the discussion, so I'll try to make my presentation very quick. So I'm Shin Takamiya. I've been with the firm for about 15 years. So I've kind of seen the growth of the Japanese startup ecosystem. When I started out in venture capital in Japan in 2008, the total amount of venture investment in Japan was only about 300 million USD, whereas last year it was ramped up to about 8 billion. So during that time, I think our ecosystem has grown significantly, and we're at a completely different stage, and probably during the discussion, I want to discuss how we can further move forward. And about our firm, Globis Capital Partners, we are part of the Globis Group. Globis Capital Partners, we have been in the venture capital business for almost 30 years, so we are one of the earliest and largest VCs in Japan, and we take very much of a hands-on approach. We typically start from Series A, pre-A kind of stage and follow on until the end and try to help Japanese startup becomes unicorns and beyond. Thus, probably one of the key elements we have to talk about today is how can Japanese startup go global. And in that sense, we in our portfolio had Mercari as Japan's very first unicorn, and definitely Mercari has become a very, very strong role model for Japanese startups. We often refer to Mercari as like Nomo, who was the very first Japanese pitcher to challenge the Major League Baseball and who did very well in the major leagues. And many others followed the footsteps of Nomo because he was the very first one who was able to develop that path. And following Mercari, Mercari went public just less than 4 years ago. We had like 30 to 40 companies reach the 1 billion USD market cap, whether it be in the private phase or early stages of the small cap market in Japan. And we can talk about the advantages and disadvantages of having that flexible open IPO window, but definitely I think Japan is now coming up with great ecosystem and also great companies too. And as for us, Globis Capital, we pretty much like to take the similar approach. We are very much of an ecosystem approach. We've been in the business for 30 years. We've been in venture capital when there was no words such as startup in Japan. There were no small cap IPO market. We've kind of grown together with the ecosystem, so we are almost like twins of the society. And by growing together, we ourselves were like a startup which happened to do venture capital business as a startup. So we want to add value to our portfolio companies, especially these days we focus on helping our portfolio companies go and penetrate the global market. And also, as we want to help our portfolio company go global, definitely essential part of our value add is the supply of capital. So we do want to leverage our network with our fellow VCs overseas and also our LP network so that the Japanese startups can syndicate like multi-billion-dollar valuation rounds with multi-million USD fundraising. So I think our strategy kind of coincides with the opportunities in Japan. So definitely, going global is one opportunity for the Japanese market, and definitely that's one of the core pillars of Globis Capital's strategy. And also, as was mentioned in previous panels, Japan is, even though we are always talked about as like an aging society and so on, but we are still number 3 economy in the world. And some markets in Japan is like $100 trillion US market. So even if you were to dominate the Japanese domestic market, and if you can be in that position, that's big enough investment opportunity. So for us, going global or dominating the Japanese domestic market is the two pillars to our strategy. And we would like to follow on from the first round to the last round so that we can help our portfolio companies grow big. And we want to utilize our network of investors and help our portfolio companies syndicate. That's kind of like our strategy. Thank you.
Excellent. Thank you. All right. Shin, if you don't mind, I'm going to stick with you for a moment. So the title for today is Venture Fundamentals and Paths to Ventures. So I'm going to unpack that. Our first questions will relate to the paths question. How does one enter this and at what timing? So you started the fund in 2008, which in Silicon Valley was a terrible time to not necessarily be at a fund, but it was a tough time we were trying to raise. And it was a tough time. I started a consulting firm in 2008. Selling to startups was very hard at that time. So it seems almost countercyclical. So I was wondering if you could speak to your origin story, leaving Arthur D. Little and then going to Globis, and what prompted the starting at that point? Because the ecosystem has changed a lot since then.
My personal story is that I am one of what we call Generation 76 in Japan. So Generation 76 in Japan is the generation where we were at university during the dot-com bubble. So all the Generation 1 startups came at that period. And all the big tech companies right now were basically started at that time. So I always had my personal passion with the startups. And after going to consultancy and then going to MBA in the US, I started to come back to what I was initially passionate about and started out in 2008. And you mentioned that 2008 isn't exactly the best timing, but
if you already had money, it was a good time to be invested.
Exactly.
So that's the nuance I want to point out.
Yeah, exactly. So I think as a long-term investor, like venture investor, 2008 is actually a very good timing to enter because during the downturn, you see the emergence of something fundamental, next big thing, and the valuations are already adjusted. So I think to enter in from that stage is actually a good investment. So I think a lot of the situation is very similar right now. COVID was there, a lot of money was floating around, and it's starting to get adjusted, and economy is kind of starting to reboost. So I think moving forward, the macro is kind of on the upcycle, and we have the new tech emerging. So I think it's a very interesting and exciting timing moving forward.
And so here I want to unpack the notion of vintage year or fund vintage year. You'll say something that was in 2002, 2008. I'm very curious as 2022 will shape up to be a good year for venture just because it was so bumpy, so to speak. So the vintage year can often matter. And at a time when startups are starving for money, if you are already liquid, you already have a fund, it's not a bad time to be looking for investments.
Right, but definitely, the vintage plays a little role in each fund's performances, but it goes into kind of niche comment, but as a venture fund manager, you want to have a stable performances so that your LPs would be, feel secure to, continue to re-up into the fund. So I think the management of venture capital firm a lot has to do with the long-term kind of fund management and stable performance delivery.
Okay, so I'm going to turn to Allison. Allison, I'm going to divert a little bit from what we talked about in the prep room a little bit because you explained a little bit in your remarks earlier. But the notion of starting by founding your own fund, I think is fascinating and probably worth hearing a little bit more about that. So breaking into venture not by joining an existing firm, but rather starting your own is a really interesting kind of case study. So I was wondering if you could speak to that decision and kind of how you went about it.
Yeah, I mean, we're in a really exciting era for venture capital because historically it was nearly impossible to break into the industry unless you were already successful, already well networked, already incredibly wealthy. And just like we've seen technology democratize access to customers and information and resources, we've also seen it democratize the infrastructure that's necessary to start a venture capital fund. So with new kind of exciting technology, whether it's Carta or AngelList, or even large institutional legal firms and investors starting to look at small or new venture funds. I was lucky to enter the industry at a moment where, even though, don't get me wrong, it was a very difficult way to break into the industry, it was possible, and I don't think that the same can be said for even 5 or 10 years prior. So, I never expected to necessarily get into venture, but I was, as you'll hear from a lot of founders and investors, at the right place at the right time, and ended up building a venture-backed company and seeing how big of an influence our venture investors had on us as we were figuring out how to define success, how we were evolving our product, how we were thinking about our global expansion strategy. And I wanted to be on the side of the table kind of making those decisions instead of the one simply being told what definition of success was. At that time I was building New York-based startups business in Hong Kong. So kind of dealing with the challenge of being on the ground and understanding the local ecosystem in a different way. So when somebody who I had built a relationship with came to me and said, would you like to co-found a venture capital fund with me? Sometimes you just have to say yes and figure out the details later, which I definitely regretted for a little while, but ultimately, it was an incredible journey to be able to build a fund and figure out the industry that way.
So there's such a thing as an offer you can't refuse, right?
Yes, exactly.
So, all right. Well, clearly it was a transformational and great learning experience for you, and that's how we, I guess, first met in 2019 when we were first connected. So. I want to shift to questions, and we're going to have a few different versions of this, which is the notion of it's a long-term relationship between the fund and the investment. Earlier, Shin was showing the number of Japan's unicorns in which Globis Capital Partners has a share. And that has certain implications about when you're meeting them and your long-term relationship with them. So the question is deal sourcing. And then I have a couple of follow-on questions about the duration of the relationship from that point. But first, if you could start with the sourcing piece of it.
Right. I think in terms of the basic of the sourcing, it's a very, I think, a network-based, ecosystem-based kind of activity. But it kind of leads into the dilemma of VCs trying to go global. Because, the way we source, and probably a lot of venture capital source, is that we are right in the center of the ecosystem. So basically, we know everybody, and we know that the brilliant entrepreneur is restarting up and becoming a serial entrepreneur or something like that. I've known the founder of Mercari from the day I started in VC in 2008, and I invested in Mercari in 2013. So we've been friends for more than 5 years, and we've been playing squash together every weekend. So it's really like you're investing into your friend. So you know that he's trustworthy, and he's not going to run away from hard things. And the business model and the business plan, that can come later, and it's always changing. So I think you got to have the right relationship and the trust with the entrepreneur to start off with, and then after investment, you got to be on the ground so that you can help your portfolio companies grow. But probably the upside is coming from globalization of the portfolio companies. So the sourcing side is very local, but the upside of the return comes from helping them go global, and moreover, Allison touched upon it a little bit, but for venture capital's business model itself, if we want to go global, if we were, for example, if we Globis wanted to invest in the Valley, we've got to be in the center of the network in the Valley, and we don't have that. So I think we have a very difficult kind of dilemma kind of situation. On the one side, we want to be very local, but on the other side, if you're aiming for the fences, you want to go global. And I think that's the challenge the whole VC industry being facing for the last basically 20, 30 years.
Yeah, there's a follow-on question I want to get to. So again, you're getting to within a certain ecosystem, which say just n equals 1,000. That's the size of the available universe, and your competitors are also in the ecosystem. You can either grow it somehow, or deepen your relationship within that universe somehow, or extend value on the other end. When you're looking for entrepreneurs and you're thinking ahead to beyond Japan, to global expansion, right, how does that inform that early sourcing or interaction process?
Well, I mean, it depends on which kind of business the entrepreneur is focused on. If it's like the big Japanese domestic market kind of domination kind of story, we're happy that, how can we dominate that market, and, we want to help them do that. But on the other side, when we see the potential of that business going global, even from the early stage, like pre-A or seed round, we want to kind of change the mindset of the entrepreneurs so that they can actually aim for going global. Like, you've seen Mercari go global. Nomo did that. So you can become Otani-san,
Yeah. Well, so I was listening, it's like there's Nomu and Irabu and Daisuke on the end. Like, which are your comparables that you're going to? So, all right, I want to ask this question of you, Allison, because you asked some differentiated hypotheses about the type of company and entrepreneur you're looking at, and I'm wondering how that informs your sourcing strategy. Because I was looking at some of the names you have there and the areas you're investing. Some you could say are well invested, some may be a little bit underserved. Mm-hmm. So I was wondering if you could speak to that.
Yeah, it's been an exciting time in our sectors. When I first started talking about this concept around the future of work and jobs being distributed and data-driven, dynamic, it was perceived as very niche. Often people didn't understand what I was talking about. And COVID served as this disruption that brought this idea of how we work changing to the forefront. And really, it was happening for years leading up to that, but especially in 2020, there was an explosion of innovation in this employer-employee relationship. Everybody was remote and distributed. And so our problem kind of got flipped on its head, where when SemperVirens was founded, it took a lot of effort to go out and really source innovation and find entrepreneurs that had the right background, were building the right types of technology in our sectors. And now it's really about how do we filter through the thousands of companies that come in through our ecosystem and identify which ones are gaining momentum. And for us, that means leveraging a number of different sourcing mechanisms. So we actually run an accelerator program called People Tech Partners, which is focused on very early stage companies. We have our ecosystem of HR leaders who we're constantly talking to about what new technologies are you using, what kind of problems are you looking to solve. We have our actual portfolio. Paul shared earlier the story of how they invested in Salesforce. We've had a very similar experience where we've talked to the founders within our portfolio and they've said, hey, I'm having a lot of trouble paying my international contractors. I need a better system for getting them employed legally and provide them with not only finances but also with global equity. So we invested in remote.com and a company called ESOP that's solving that problem. So often, just like it takes a couple times for you to be served an advertisement to buy a product, we really need to hear about a company 3, 4, even 5 times before we know that this is something we actually want to pursue. So it's definitely changed, but it's an exciting time.
And I'm going to say that hopefully the funds that were already in the portfolio found their vector greatly amplified.
Definitely.
Post 2020. It was interesting, one of the earlier panels referred to disruptions and then the need for technology or opportunity for technology-based solutions. A lot of those solutions were there, or already in use, but have been greatly amplified and expanded based on events that have changed. So sometimes startups find their timing, sometimes it's a matter of not wasting a crisis, but hopefully there's an amplifying moment.
Yeah, and it could also, I think for many companies, it was also too much of a good thing.
Yes.
Where you start to demonstrate this absolutely exponential growth, and then expectations are so high, it's nearly impossible. We saw that a lot within our education technology portfolio. But we also witnessed something that we call, we look for product market fit, but in many cases we only found product COVID fit, where there was a lot of demand for a product. I think we saw this in the virtual event space, for example, where these multi-billion dollar companies were created virtually overnight because they were serving a need that really changed when COVID has started to fade into history. So that was something we spent a lot of time analyzing during our diligence process.
But probably one interesting point is that, as you mentioned, technology was always there, and the society and the human side has changed. So I think it became easier to identify the global kind of similar opportunity which goes across different countries. So I think, especially for the Japanese startups, it became easier to identify the global opportunities and trying to pursue that starting out from their original country.
Mm-hmm. Very good. I want to kind of speak to the nature of the relationship between fund and investment. I'm a mentor at Berkeley Skydeck, for example, and so sometimes I'm meeting with entrepreneurs, I'll say, here's why you need to be thoughtful about the construction of your cap table. You're going to be having a relationship with these people for maybe 7, 8, 9 years, so obviously you need the money now, but be thoughtful about where the money is coming from, because this entity is going to be kind of a presence in your life, right, for a long time. And so I was wondering if you could speak to that, sort of like not only the duration, but how the relationship maybe evolves. So if you have specific examples within the portfolio that you could speak to, that would be super helpful.
We partner with companies at the very early stage, so typically seed or Series A, where they have a few customers, but they're just getting started. And we're able to provide, through our ecosystem, connections for them to potential customers, but also friendly faces that can provide them with the feedback they need to hear in order to scale into those customers. So, for example, the former CHRO of IBM is one of our executive advisors, and she spends time with our companies telling them exactly why she wouldn't buy their product, including security requirements, ability to scale, customizations required. For any software business, selling into a large enterprise requires a lot of resources, and you often don't want to sell into those customers too early because you end up building a product for them instead of a product that will scale. So I think it's very similar to the process of going global, where you need to be able to provide this insight to founders very early on. Karen made the point earlier about how you need to think about product requirements and how do you adapt to new markets from the very beginning. But if you do it too early, it can be a company killer. So our ecosystem can scale with our companies. We have, within our CHRO community, we have chief people officers at other venture-backed growth companies. They want to be early customers. They want to use what's off the shelf. They want the cheap solution, and they're willing to take a risk and work with a new business. So we can make those connections early on and then provide the insight and the resources in the network to scale into larger customers over time. So I think being able to find relationships with investors, and this is true on the LP side as well, where they can scale with you and provide value not only from day one, which is great, but ultimately continue to provide that value. Because even if you're getting a relatively small check early on in your company life cycle, those small checks buy big percentages of your business.
Yes.
And as you continue to grow, later stage investors, even if you're very lucky to be able to grow quickly, that means the later stage investors are actually buying less than those early investors. So making sure that they continue to earn their right to be in the boardroom, to be providing that value, I think is really important to think about from day one.
I'm going to unpack one point you made, which is important, is the notion of not N of 1, but N of 100, N of 1,000, something that's scalable as particularly relates to enterprise tech. And so certainly calling that out or having someone call that out to the startup early would be incredibly, incredibly valuable. So. Yeah,
being able to see around corners. I think that's our role as investors. I think somebody made the point earlier today about, what do we really know? We're not founders today. We're not experiencing your business like you are as an entrepreneur, but we can provide what we've seen across many, many different companies and patterns we've seen and things we've seen go wrong to help just plant that seed so that you know what's coming around the corner.
Okay. And then, Shin, this might be a good segue to what we talked about in the prep session, the notion of startup 1.0, 2.0, 3.0, and then I'd love to get to your value add in that 3.0, which maybe picks up on our earlier question. So.
Okay, so the very basics of the value add of the venture capital. For example, back in the 90s or 2000s, when in Japan, even the risk money was missing. So providing the risk money is like the very basic kind of 1.0 of VC value add. And then it kind of became like value add for us to become like a mentor and coach for the management from the general management kind of perspective. And then came the big wave of 3.0 is like a value add team where we would help our portfolio companies on a very leverageable operational level, for example, executive CXO hiring and things like that. And that's kind of 3.0 as where we stand right now. But probably moving forward, I think helping the portfolio companies go global is going to become like the key thing. And as I mentioned, there's like a dilemma of VCs ourselves not being able to go global very easily. So I think there's a lot of room for collaborations between VCs across the globe so that we can, help each other bridge to the value-added investors in each market, and so that we can create great global companies, whether it be originating from Japan or whether it be originating from the US. If you want to penetrate the US market, or if you want to penetrate the Japan market, we want to make the best syndication to help the portfolio companies. And probably, that's on the flip side, is that, the VC side is like that, and I think the development of the startups are coinciding with that evolutions too.
Okay. And so that's where, when we were talking in the prep session, the Entrepreneur 1.0, 2.0, 3.0 might have been a better way to frame the question.
Yeah.
If 3.0 was, say, Merukari, 2.0 would refer to perhaps an earlier generation.
Yeah. So as for Japanese startup, I mean, 2.0, the 1.0 was, back in 2000, where we would just do the time machine model, copying the Silicon Valley model, and that was good enough, And then came like big tech companies who would dominate the Japanese market, then go public, and then go to overseas market. And sometimes, it was too late to win in the global market, especially when you're in the very fast-moving digital arena. And 3.0 was like company like Mercari and Smart News, where they would penetrate the global market during the private phases because they were able to get enough supply of capital to go global. And the next generation is just emerging in Japan. For example, Joshis, a startup started by Matsumoto-san, who is a serial entrepreneur who's founded Raxo, which touched down to 3 billion market cap at once. He raised 200 million in Series B, which in this fundraising environment is very, very difficult, even across the globe. So it was even a big sensational news, even in the US or overseas. And then he is kind of like doing a multiple launch across different countries from day one, 30 countries all at once. And the reason why that makes sense is it kind of goes back to my previous comment as identifying a global opportunity. So Josis is targeting a IT management problem for multinational companies. So multinational companies may be headquartered in US or in Japan, but the pain is kind of the same. So even if you're a Japanese origin company, there's no disadvantage of tackling that segment. So compared to tackling the US domestic market, there is a disadvantage in that. So I think for Japanese startup, if you are able to identify and target purely global opportunities, there's no kind of disadvantage compared to overseas startups.
And rather, it's a how to sell question. Are you selling directly or indirectly or through partners, et cetera?
Yeah.
So I want to go to the question that we talked about, VC 1.0, 2.0, 3.0. I want to frame it a little bit first. So I was with a startup in the 2000s that was funded what I would call 1.0 era VC, where we had a general partner, and that general partner could bend time. And what I mean by that is a well-placed email from that person could shorten time by a year. If he emailed the right CTO at the right company, my life would essentially, or my progress would leap forward a year. And that was sort of 1.0. You got a partner who would support you and every once in a while make a well-placed introduction and make your life better. 2.0, you might say, is more what we heard about earlier from Andreessen Horowitz, sort of noting that a lot of portfolio companies will have common problems, and they don't need to solve them all themselves at an early stage. And the fund itself can operationalize some of those capabilities and solve those problems or handle those functions on behalf. And then that sort of gets to what's 3.0, which was in your presentation. I'd love to kind of hear more about that.
Yeah, exactly. So we think about VC 1.0 as capital, right. Needing money to scale, as the cost of building a company, with cloud infrastructure and new resources on the software side to support smaller businesses. Actually, the cost of scaling a company has come down dramatically. And then we kind of saw the emergence of this VC 2.0 with the platform concept of we can add value to how you're building your business, either by supporting you with marketing or PR or pitch deck support, financial modeling, internal company processes. And this was very new, with funds like Andreessen Horowitz, which kind of pioneered this model. I would argue today it's become table stakes. And ultimately is not an adequate differentiator when you're competing to get access to a great company. Especially as a smaller fund, when you're competing with multi-billion-dollar entities that have multi-billion-dollar resources, we've had to figure out how to really differentiate ourselves and provide different value to founders. And that's how we kind of arrived at this thesis around VC 3.0, which is an ecosystem-driven approach. And ultimately, what we do at SemperVirens, and I think what you do as well around international kind of expansion, is providing resources for distribution. When we started SemperVirens, we were writing very small checks, 100K, 200K. Our average ownership was around 1%. But our companies from that fund actually frequently will say that we were their #1 most value-added investor because we brought them 20 of their first customers. We introduced them to large channel partners that helped distribute them to multi-million-dollar contracts. And so it really is that distribution relationship that provides the most differentiated value, and that requires specialization. So I think early VC 1.0 and 2.0 is much easier to be a generalist fund, but today, in order to provide that unique value add from an ecosystem approach, you have to focus in some way, and so having a sector focus and a deep network and expertise and connections that support on distribution is really one of the only ways to stand out in this market to incredible founders. So I think we're just going to continue to move in that direction, especially as we see continued democratization around starting funds and running funds. LPs are pulling back right now, but this idea of more entrepreneur VCs is not going away. And so being able to take that approach is really important.
Thank you. So I like the message of democratization of funds. So it's a very positive one. On that note, just kind of to expand on what Allison just said, a lot of funds in the past 10, 15 years in Silicon Valley have added marketing partners or HR partners, operating partners, people who on board who help with some of the operational problems that portfolio companies may encounter, and it's become more and more common to have that capability to an extent in-house. And at some point, the portfolio company will grow and bring those functions in themselves, but they can borrow the partner of the investor at the outset.
And it's not that it's not helpful. I mean, even
absolutely.
though we have this community of 150 senior HR leaders, we don't provide HR and people support to our portfolio companies because they don't need it. They can get it from their other investors. Right. So I think it's more about really figuring out what makes you different as a fund.
Absolutely. All right, I want to get to a message which I think is part of the premise of this very event, which is that the notion of kind of trans-Pacific or Japan-US collaboration. And can funds collaborate more? Are there areas where it makes sense for US funds to maybe collaborate with Japanese funds to invest in a certain area at a certain stage, or vice versa, for example? And certainly you see a lot of it at an ad hoc basis where a partner knows a partner and they share deals with each other. But I was wondering if you could speak to that dynamic. I know, Allison, you had some very specific hypotheses about how to kind of operationalize that, so maybe I'll start with you.
I write about a concept in my book called look for collaborators, not role models. And whether you're breaking into venture capital or you're breaking into another, a new market or a new industry, there are a lot of people you can look to who have done it before, might share their advice on what to do, or you might build a relationship. But ultimately, there needs to be some sort of concrete collaboration, and ultimately, in my view, a financial transaction in order to solidify a partnership and make sure that there's aligned incentives to actually move forward. As venture capitalists, we meet, I think I meet probably 12 to 15 new people every single day, and a lot of them are really great, and I wish I could build relationships with all of them, but really, ultimately, you prioritize your portfolio companies, you prioritize your LPs. So it's been really interesting to see, I think, a lot more larger funds doing fund-to-fund investments, figuring out a way to build commercial partnerships in order to ensure true collaboration and aligned incentives. And I'm a big believer that you need that, or else it's just going to kind of fall by the wayside as something that would be really nice and that you'd love to do, but ultimately, time is our most valuable asset, and we don't have enough of it. So I'm a big fan, kind of believer that needs to be in place in order for something to happen.
So as, say, a US domiciled early stage fund, then having an LP who is a Japanese fund who can enter and maybe help start at a certain level with kind of structure right? What others would may just be kind of a nice to have relationship, for lack of a better word.
Exactly. In order to really get access to not only trends, insights, portfolio companies, potential investment opportunities, but also access to that ecosystem. I mean, we have many LPs that also make their own direct investments, and they want us to help support those direct investments in their expansion into enterprise or whatever it may be. And so that's one of the ways in which we collaborate of, hey, maybe we're not investing in this company alongside you, but because we have a financial relationship, we can support through the ecosystem as well.
All right, now Shin, going the other way. If entrepreneurs are looking to you and saying, help us go global, and there's only one of you, right? So, and you're here right now. So how are you going about maybe operationalizing this either individually or as Globis?
Right. I think there's two elements to it. You know, as I mentioned, to tackle that dilemma of local versus global element.
Where do you focus?
Yep. I think you know, a lot of VCs are local focused, and you know, we can't, for example, Globis, we can't really value add at this moment in the US. So I think important thing is being able to give a path to US investors who can, you know, value add in the US market. So I think what is important, number one, is I think the relationship, even with investor to investor or potential investor to startup, it doesn't start off with a deal. I think the personal relationship has to be there to start off with. So, you know, for example, if we were able to establish a good, you know, trustworthy relationship with the US investors and, you know, kind of give a word of reference to them and say, hey, there's interesting startup or entrepreneur who might be potentially going into the US in 2 years. It might be interesting for you to see them beforehand. You know, that kind of introduction, I think, is very important. So that, you know, the more foreign the investors are, they want to know that entrepreneur in person. So I think having that long-term relation is very important. But having said that, on the contrary, number two is when it comes to like the concrete deals, you know, like 3 months before you want to fundraise or something like that, it's about kind of coming up with a win-win kind of deal structure, very kind of, you know, financially oriented. You know, there has to be like a merit for the startup, have to be merit for the existing investors and merit for the new investors. So to be able to syndicate that right structure, I think, is a very important thing. So the fundamentals are the personal relationship and coming up with like a, you know, feasible and win-win kind of structure is the second that builds on the foundation.
So you described a very nuanced mix of both soft and hard, so to speak.
Yeah.
Right? Which is super interesting. Like there's a little bit of a warm relationship, but it does come time to how do you actually carve out equity in a company on behalf of this new investor. So
even when I started out like 15 years ago, you know, we had this kind of concept of having a VC star alliance, which is like airline alliance, loose alliance, so that, you know, we can give paths to each other. But at the time, we had very little number of Japanese startups really pursuing global expansion. You know, some people said they would, but, you know, no actual deals came out of it. So relationship kind of ended up with just like a small talk kind of relationship, and nothing really happened. But now I think the ecosystem and the market has changed so that we can come up with concrete deals. So we can do the number two kind of, you know, concrete win-win structure with the partners.
Right, because within the code-sharing alliances, the same model from Boeing or the same model from Airbus, there's a lot of operational assumptions underneath that model. So interesting. All right, I want to get to maybe Japan as a market, either to enter or to learn from, right? And this picks up a little bit what we were talking about earlier. There were a lot of comments about sort of the maturity of the ecosystem in some ways, but we were also talking about areas where Japan maybe over-indexes in some ways. Allison, you and I were talking about climate, automation, and broadly the theme of aging as one where it may be more favorable for either a US company to enter earlier than they might, or at least learn from what's happening in the market. And so I was wondering if you could speak to that. And just to supplement the point, when I was in mobile in 2000s in the US, Japan might have been your second market or your third market. And then that changed with software companies and hardware companies where Japan often became after entering the EU, after entering maybe Singapore. So like a Series D market, so a much more mature company. But has that kind of tipped in the other direction is kind of where I'd love to go with your observation.
Yeah, I mean, having spent time living here in Japan, working with Japanese partners and helping companies launch here, I think there are two pieces where US investors and founders can learn from the Japanese market. I think, first of all, just like the sun rises first in Japan, I think what's so interesting about the market and the economy here is that Japan is facing some of our biggest global challenges first. What does it mean to have decades of low interest rates? What does it mean to have a rapidly aging population? What happens when you invest in longevity and wellness and well-being? And these are things that I don't think Japan has all the answers yet, but you are further along in the journey of leveraging technology to find solutions to these areas. So I think there's a lot of learning from how Japan responds and how innovators here find solutions. And then the second piece is, as you mentioned, everybody kind of thinks, well, we'll launch in Japan, maybe second, third, or fourth. But the way that I've seen partnerships forged here is an incredible lesson for developing partnerships in any market. The level of preparation and detail and just thinking through various complex scenarios is something that happens before you sign a deal in Japan. And I think we need to take a page from that playbook. I've seen so many entrepreneurs either burned or, at the worst, burned, wasting millions of dollars launching in markets where they didn't think through all of the details. Or at the very best, they're just very disappointed and wasted a lot of time. And so kind of applying that Japanese approach to partnerships, I think, can be really valuable no matter where you're expanding.
And here I'm visualizing like a super detailed Excel sheet with like 150 questions. What if this happens?
Right? I mean, it's like...
Answer this question.
Yeah, it's incredible.
I've received a few of those.
Yeah, exactly.
Right. Shin, I was wondering if maybe you could speak to that.
Before my comment, probably I want to ask Allison one question. For let's say US company or foreign company entering into Japanese market, as you mentioned, the business kind of protocols are a little bit different, and it could be difficult. But definitely, there's a potential of the market. So, what can partners in Japan, whether it be like a channel partner or VC partners or like a startup kind of alliance partner, what can they do to help navigate foreign companies penetrate the Japanese market? What would you look for in a Japanese partner? What can we do? Yeah. Right.
Yeah. No, I love that. And when I was thinking about sort of this concept, I was realizing that all of the principles I share in my book about how to break into venture capital also apply to how to break into Japan. So this idea of helping founders think through, how do you access the best opportunities? How do you leverage, one of the main principles in the book is networks trump knowledge. It's not what you know, it's who you know. And figuring out the best pathway to the right people is hugely valuable. How do you analyze which opportunities to pursue? A lucky founder will have many choices of potential partners, and so how do you figure out which ones are going to move forward? Thinking through timing, incentives. There's a chapter in the book called Money Matters, which is figuring out what actually incentivizes the person that you're partnering with. So often, I think founders and potential partners here in Japan get together, they share a mission, they get really excited. But really, at the end of the day, what the founder needs to be understanding is, how is this partner going to make money? And how can I figure out the details of that in order to align myself in the right way? And I think partners that can provide that insight, which nobody will tell you in a meeting, can be really valuable. And then finally, kind of how do you add value after you solidify a partnership? And the final chapter in the book is called Stay the Course, because you cannot measure success in venture capital in a week or a month or even a year. And so finding partners that can help founders think through that and understand, what are the things I can measure in the short term that will keep me moving forward? I've seen so many companies come here and just give up because they don't see progress immediately. Right. And so I think the best partners can help kind of think through that of, how do you measure your process to ensure you're still moving in the right direction?
Right. And I think vice versa, in a Japanese startup's shoe, I think same could be said. For Japanese startups to go global or go into other foreign local markets, I think they probably are very much used to the Japanese local protocols, but they want to be versed to the global protocols or the local, standards. And I think step one is realizing the difference and having the right navigator so that they can realize that difference. And probably more fundamentally, the step two is hiring the right local kind of management. And I think, having the global talent into a Japanese startup, I think is a very, very critical issue for Japanese startups moving forward.
Yeah, I want to pick up on that point for a second, because it actually, it loops back to something Nishimura Daijin said at the very beginning of the event, where he was talking about greater labor fluidity. All right, people quitting after 3 years, more fluidity in the market. And he made what I thought were some very good points about quality of the work environment in Japan vis-a-vis other environments, right? Which are very true, right? It's a very good, safe, wonderfully operated place to work. And so I was wondering if you could speak to that fluidity and then the hiring question, maybe as a package, because I feel like there's a service offering waiting in there.
Yeah, it's a very sensitive issue. I mean, as a society as a whole, Japan has been like an island nation, and we were very siloed, so we never had many, immigrants coming in. And also in terms of the labor law, Japanese in the Showa era, we are famous for the lifetime employment and family type of employment. So the companies were supposed to look after you for the total of your career. But I think, things are changing quite dramatically. So it's getting a little bit like the valley where you might pursue your career almost like a project base. When a project ends, you change to another project and things like that. And I think that's the kind of big direction we should go. But, having been able to fire people at once in Japan, I think it's not socially and politically accepted. So I think we have to do like a Japan customized way, like where you can have the liquidity of the labor force only in like a global talent or high career kind of talent or things like that. So I think we have to devise that kind of new system, and probably the people at METI can help us do that.
And I think it's a really interesting point because, obviously we invest in this space and think a lot about labor market liquidity. And I think it applies, in a multitude of ways. I think, Ben was talking earlier about how he was speaking to somebody here in Japan, and they were talking about their policy compared to their policy 5 years ago. But that really doesn't matter. What matters is that policy compared to every other country's policy. And I think we're seeing that in workplace environments as well, where so many employers kind of said, well, our quality of life is better than our competitor. And that doesn't matter anymore because your employees can go work anywhere they want. They can build a freelance career online. They can start their own company. The number of options is so large now that you have to be thinking more creatively about what those opportunities are. And so it's really important, I think, for founders as well as large companies to realize that there are so many more choices that it's not about, we're never going back to the way things were, no matter what the policy is. And so we have to embrace this kind of new multidimensional world of employment.
Yeah, I think for the young generation and the young entrepreneurs, what we have to realize is that, let's say, democratization of entrepreneurship is happening. You might be a freelancer or small business. You need that entrepreneurship to be able to kind of, deliver value in the new society. I think in the very long distance, that's going to happen in Japan too. But the question is the midterm, how we're going to transition to that phase with the feasibility. I think that's kind of like the question we're facing right now in Japan.
So I'm going to introduce a term I heard in a Nordic context, which is that of flexicurity.
Yeah.
Where if you have a strong social safety net, it's easier for labor to be fluid because if you leave your job, you'll have a cushion waiting for you, and then you could go to the next job. So I'll introduce that term. The seconds are counting down on the panel, so I want to take a moment and thank our two panelists for sharing a lot of insights. You packed in a lot in a limited hour, so thank you both for being here. Thank you so much for your time and insights today. So with that, a warm round of applause.